Private credit is the next 2008 collapse, but it's worse. Morgan Stanley just trapped retail investors inside an $8 billion fund. Morgan Stanley. They are the fifth major private credit company to show signs of stress. First it was Blue Owl, then it was Blackstone, not to be confused with BlackRock, but then it was BlackRock, and yesterday two more, Morgan Stanley and Cliffwater. Cliffwater is a huge one, even if you've never heard of it. And this is exactly how 2008 started. In 2007, massive names in mortgage-backed securities started showing signs of stress, but then everyone said, no, there's nothing wrong here. It's just temporary, until 2008 came along and the world collapsed. Back then, it was $1.2 trillion. Today, we're watching the real-time collapse of a global $3 trillion private credit bubble. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. Let's figure this out together. For the last few years, Wall Street has been aggressively pushing something called private credit. They tell you that it's the ultimate safe yield. They package highly leveraged corporate loans into business development companies, or BDCs. Now, these are corporate loans that the banks aren't even willing to give out because they're too risky. So what they do is they give money to risky companies and they package them into something called BDCs. They then sell those BDCs to retail investors because institutional money is quietly backing away. No one wants to back these companies, so they sell it to retail investors. And they promise juicy 10% yields. And most importantly, quarterly liquidity. They tell you that you can take your money out 4 times a year, but the reality is a massive structural lie. You cannot offer quarterly redemptions on multi-year, highly illiquid corporate loans. When times are good, the incoming cash flow from those loans covers the normal exit request. When times are bad, everyone rushes for the door at once and it becomes a race to the bottom. And right now, the smart money is sprinting for the exits. Even JP Morgan, yesterday they said they are going to stop lending money to private credit or lend less money. JP Morgan is sprinting to the exit. I mean, that tells you something. Why though? Well, Morgan Stanley just filed regulatory data showing that they capped redemptions on their $8 billion Northern Haven private income fund. Investors demanded almost 11% of their money back. Morgan Stanley handed them less than half of that, enforcing a strict 5% cap. So if you asked for $10,000, they gave you $4,500 and told you to sit down and shut up. This is a full-blown contagion now, because first it was Blue Owl that halted redemptions on key tech focus. That's a key tech focus fund, by the way, last month, because requests jumped to 15%. They had to sell off $1.4 billion in assets just to fund liquidity. Then Blackstone's massive $82 billion, that's a lot of money, 82 billion B-Cred fund saw a record $3.7 billion in withdrawal requests. Then BlackRock curbed withdrawals on its $26 billion H-Lend fund after the request spiked to 9.3%. They only gave back $620 million and they trapped the rest. And today, Cliffwater just gated its $33 billion flagship vehicle after investors tried to pull a record 14% out of there. Then after that, it just gets worse and worse. Morgan Stanley just trapped retail investors inside an $8 billion fund. This is over $150 billion in retail capital suddenly trapped behind Wall Street's gates, right? So the truth is right there in the data. The entire sector is freezing up simultaneously. But here's the bigger problem. Why is everyone suddenly trying to get their money out? The answer comes down to one word: software. These private credit funds are absolutely stuffed with loans to tech and software companies. Blackstone's B-Cred has roughly 25% of its portfolio in software. BlackRock's H-Lend has roughly 19%. And right now, the AI boom is completely disrupting the earnings power of these legacy software companies. They simply can't repay their debts. So they've taken on money, but they can't repay their debts. So which one of the big banks is quietly pulling the plug behind the scenes? Of course, it's our friends at JP Morgan, sarcastically saying friends, obviously. JP Morgan has roughly $22.2 billion in exposure to private credit, and they just started proactively marking down the value of these exact software loans. They are restricting the back leverage these funds rely on to amplify returns. It's leverage upon leverage upon leverage, as it usually is. That's what always leads to these crashes. So today, the chairman of the Partners Group warned that private credit default rates could double over the next few years. The historical average is 2.6%. A doubling puts formal defaults at well over 5%. But honestly, guys, it's probably going to get a whole lot worse than that. These guys always underestimate these things. And that doesn't even count the shadow default rate, by the way. Companies are paying interest with more debt. That's the shadow default rate. So they're losing money, they're paying interest by taking on more debt, and this is called payment in kind or PIK. The shadow default rate has already doubled to 6.4%. So you have failing loans, crashing collateral, and trapped retail money paying management fees to the companies like Blackstone and BlackRock who provided these loans. Every dollar trapped behind their gates continues to generate yield for them, continues to generate fees for them. There is zero financial incentive for them to ever let you leave. It's a system designed to suck you dry, allegedly. This is the exact same liquidity mismatch that we saw with the subprime mortgage disaster CDOs in 2007. Back then, banks took bad mortgages, sliced them up into junk products, gave them a AAA rating, and blew up the entire global financial system. Today, they package toxic corporate debt, slap a shiny BDC label on it, and sell it to you, and then they freeze your account when the underlying businesses start failing, and you want to get your money out. Now your money is their money. Congratulations, as it always is. Wall Street is officially using retail investors as trapped exit liquidity. The institutional vultures are having an absolute field day. And another thing, BlackRock, Larry Fink from BlackRock is trying to take 401k money from American pensions to put into his failing private credit fund to keep the game going just a little bit longer. So what do? I would just suggest talking to your investment advisor, especially if you've got a pension fund, and just seeing if you have exposure to private credit. And if you do, you might just ask some questions and say, hey, is it a smart idea to keep my money in here when JP Morgan's running for the door? Just ask those questions, do some research. Other than that, if you want to see other tricks the banks are pulling, especially JP Morgan, what they're buying right now while they're telling you to buy something else, check out my video from yesterday on my main channel. It's popping up on the screen now. I'll see you in the next one.